had a very fun 2-week period. I know it was a slight off time for those of us who were on campus, and we just started up. Well done on your assessment results. Everything has been published. If you have any issues, please let me know. You can always email me. I'm happy to answer and help anywhere I can. ICE tasks are going to be due very shortly, so if you have any issues there, please let me know as well. And okay, without further ado, let's continue with the theory of the firm. Okay, so specifically production, revenue, and costs. So we got quite far in the previous lesson, so let's just do a quick bit of revision before moving on. Okay, so I think if I can remember correctly, we did get all the way to point 4. So we're just going to do a quick summary. So we looked at what the theory of the firm is. Primarily, they're focused on maximizing their objectives, which is typically profit. We rely on firms to turn inputs like land, capital, labor, and entrepreneurship into outputs, and the determining or decision-making aspect is the firm. So how those resources are allocated is conducted by the firm itself. We have modernized our approach to the objective to a firm. So it's no longer simply profit maximization. It also incorporates market share, your competitive position within your industry, as well as your triple bottom line, which is your corporate social responsibility, which encompasses all your ethical business practices. And then, of course, we look at sustainability, so your long-term vision. So it's not just about making short-term profits, it's about making long-term sustainable businesses. To reach those objectives, the firm is faced with a few critical decisions, predominantly in the areas of production, pricing, and resource allocation. So these are all critical aspects that have their own factors that management needs to weigh in before making a determination. So for production, it's quantity, methods, technology, capacity, and quality standards. For pricing, it's about elasticity, the product and where it's positioned, your segmentation, market strategy. And for resource allocation, obviously, it's about return on equity, it's return on investments, and using your materials in the most efficient manner to maximize your profitability. We looked at how firms function, their inputs, the process of operations and production. We looked at the outputs of those goods and services and how they are delivered to market to generate sales and therefore revenue for the firm. We have different interactions with markets. So we have firms that exist in these different market structures. So we went all the way from perfect competition to monopoly. Okay, in between, we have monopolistic competition where there are many firms, but they act as a monopoly. And then you have an oligopoly with only a few firms. Think predominantly the telecommunications or banking industries in South Africa. Monopoly would obviously be someone like Eskom, which has their monopoly protected, or Microsoft. And then perfect competition would be where there is no difference between the products. So homogenous products may be many firms, something like the bread industry or the food industry in South Africa. We examined the principal agent problem. So principals, the owners, are obviously concerned with maximizing the value of the firm. They do it with limited information and control. The agents are the managers in the firms, and they have their own priorities. They often, or they can prioritize their personal interests, and we looked at that because they want to secure things like bonuses and job security and additional benefits, whereas it sometimes can be prioritized over maximizing shareholder value. We also looked at key ways to solve these problems. We looked at performance-based incentives, monitoring mechanisms, and effective corporate structures. So governance forms a clear way of establishing the rules and structures so that we have, for example, shareholder voting. At which point, what triggers shareholder voting? And what are the reporting requirements? We also have monitoring, like a board of directors providing oversight, as well as additional audits conducted by accounting firms. There's also incentive alignment. So we give equity ownership to a lot of directors, people with agency and power within your company, so that you incentivize them to align their personal goals to the goals of the business. We also considered the role of knowledge and technology in production. The improvements in technological advancements, obviously, the idea is that it reduces inputs while increasing outputs. So our key summaries were the real world business operations, understanding why the firms make the decisions they make in production and pricing. We looked at their economic decision making, how they allocate scarce resources, how the market influences those decisions. From a business perspective, we looked at how a firm prioritizes aspects of their business, but prioritizing perhaps profits over sustainability or agent versus principal issues, competitive positioning, growth decisions, who makes those decisions and why. Then we looked at the practical applications. So there's public policy and there's market analysis that needs to be conducted in order to make the best decision for the sustainable aspects of the business. Then we had the economic system understanding. So we looked very briefly at the spectrum of monopoly to perfect competition. Okay, so here we looked at legal forms of firms in South Africa. We took a look at sole proprietors, private cooperatives, partnerships, public companies, and state-owned enterprises. If your textbook does mention CCs, just remember that those have now been replaced by private companies. We looked at the differences between these different forms of ownership. Obviously, the private and public companies are the ones with limited liabilities, and the public companies are at least publicly traded, whereas the private companies are owned by the principals in the business. We looked at cooperatives and state-owned enterprises. Obviously, you've got Eskom and Transnet versus cooperatives, which are typically housed in the agricultural market. They tend to want to negotiate as a group rather than as individuals to balance out the power dynamics. Again, we're just reiterating the objectives that go beyond just maximizing profits. Then we looked at what profit maximization looks like in real terms or in mathematical terms. So we looked at a profit maximization model that can be applied. So that is where we're looking for an output, so a number of units where your marginal revenue equals your marginal cost. We looked at what marginal or what marginal means. So marginal in economics means with each additional unit. Okay, so here we're looking at with each additional unit sold, what was the marginal cost of producing that additional unit? Okay. And then obviously for profit maximization, we want the difference between total revenue and total cost to be maximized. We looked at the difference between accounting profit, which looks at only your revenue and explicit costs. And then we looked at economic profit, which also includes your implicit costs. Implicit costs being the opportunity cost, how you could otherwise have invested your money in the next best option. We looked at normal profits versus supernormal profits. Supernormal profits are obviously dangerous because they attract new entrants into the market, and we used AI as an example there. They were supernormal profits, and therefore they've attracted an infinite number of, or what appears to be an almost infinite number of competitors into that market, and now they are drawing the costs down and making total revenue particularly difficult to maximize. We also looked at the profit formula. Okay, so what the profit maximization model actually looks like, graphically depicted as well as mathematically depicted. So you know that total revenue is price multiplied by quantity. Total cost is your total fixed costs plus your total variable costs. Obviously, your total fixed costs are the costs that, as the name implies, don't change on a month-to-month basis, whereas your total variable costs are determined by your level of production. Okay, so in other words, it includes labor and materials, which are directly involved in the variable aspect of your business. Okay, we looked at them graphically as well, so you can see that there is a point where they cross over, where your total revenue actually meets your total costs, and that's what we call the break-even point. Okay, beyond that, you start achieving profitability, where your total revenue is now exceeding your total costs. But you'll notice that it's not a straight line. You'll notice that there are slight curves because there's a point where you reach a maximum number of units that you can potentially sell into the market. So your total revenue starts to flatten out. And your total costs get to a point where you go beyond optimization. And at this point, your costs are rising to the point where they're actually gaining on your revenue. So the point that you want to be at ideally in your business is where your total revenue and your total costs are a maximum gap. At that point, you've reached optimal production levels. Okay, so we looked at how accounting profit and economic profit both give you different considerations and business implications in the long and short term. Okay, so we had the revenue basics. So we looked at these two models in isolation. So here, when we're just looking at revenue, total revenue, you can see that it is simply the quantity or the units that you have sold versus how much you've sold them for. Okay, so we just multiply those two together to get your total revenue. Profits will, of course, always be total revenue minus your total costs. And then we've given you an example there that you can work through. Okay, then we looked at average revenue and marginal revenue. And we said that average revenue is the total revenue that you've achieved from all the units you've sold divided by the quantity of units you've sold. Whereas marginal revenue was concerned with the change in total revenue and the change in quantity. So there we're looking at the difference between average revenue and marginal revenue. Okay, so here's an application example, just to refresh your memory. So a firm sells 10 units at 50 Rand each, then increases sales to 11 units at 48 Rand each. Now, the original average revenue was 50 Rand per, or $50 per unit, and the average revenue is now going to be $48 per unit, okay, because they've sold 11 units. So what we're concerned with here is your marginal. So here we're just concerned with your average revenue, well, how much money are you taking in, versus with marginal revenue, we're considering what is the implication of these changes in both price and quantity resulted in. Okay, so that's where we can see that by selling that additional unit at a lower cost, we've actually achieved $28. Okay, so when marginal revenue actually equals 0, that's when your total revenue has been maximized. So the key relationships you need to consider that, and they are different for different market structures. So in a perfect competitive market, you want average revenue to equal price and equal demand. So when your marginal revenue lies below your average revenue, except in a perfect competition, that's where you will achieve your maximum profitability. When you have an imperfect competition, which is what we typically experience, you want your marginal revenue to be 0. Okay, that is when your total revenue has been maximized. Now, there are price takers and there are price makers. Why is this relevant? Because now we're looking specifically at the different market structures. Okay, so you've got your perfect competition who, because there's so many firms who are entering the market, they are price takers. And then in a monopoly or oligopoly sense, they are price makers. They make the decisions over what the market price is. Okay, so we looked at the role of the profit equation and how these firms have to determine the profitability that they're aiming for. Okay. Now we start looking at production in a little bit more detail. You'll see that this is going to, again, roll back up into the costing aspects of the business. So we look at both the short and long run, because here you'll see in the short run, we consider that usually your capital is fixed. In other words, you've got a set amount of machinery available for labor. Now, labor is the variable input. That's the part that you can easily, adjust. In the long run, however, you could put in, if you had 10 years, you could put in as much machinery as you need. You could build a whole new plant. So in the long run, all inputs are variable. Okay, so we looked at fixed inputs. Again, that's factories, machinery, and we looked at the variable inputs, which is labor, raw materials, energy consumption, etc. Okay, and then we looked at the law of diminishing returns. And I mentioned to you that there are a few words that you'll find that reoccur in economics. I'm sure you've noticed that as well. The law of diminishing, okay, diminishing means that as the total is increasing, the marginal is decreasing as well. So essentially, though you are gaining in the total amount or the total units that you are receiving, they are increasing at a diminishing rate. Okay, so they're losing momentum as they're increasing. Okay, so our short run production function was, of course, that quantity is a function of labor and capital. Okay, obviously in the short run, capital is fixed. So this is what our graph initially looks like. Okay, essentially what we're looking at here is that you can see that because your capital is fixed, you reach a point where you've maximized your additional labor. So your total output when you've employed 9 people is 96 units, but by the time you get to 10 units, you start to decreasing the output. Why? There's simply too many people in the factory. Now at 10 people, there's overcrowding and everyone is less efficient. The importance of this analysis, we also considered that. We looked at the assumptions of the short runs. So specifically, if they do ask you what are the assumptions for all short run production analyses, it's that technology is constant, that you have homogeneous inputs. Okay, the quality is identical. You have fixed inputs. So usually capital is the thing that's fixed, and your optimization goal is to maximize output. Okay, for a given number of inputs or to minimize costs to get additional outputs. Okay, we looked at the law of diminishing returns. So specifically for revenue. As more units of a variable input are added to the fixed inputs, the marginal product of the variable input will eventually decline. So this is what we saw when we employ more people than our factory can hold. Therefore, we cause overcrowding and inefficiencies, and therefore we start getting diminishing returns. Okay, so we looked at total product, average product, and marginal product. So here again, we see total, average, and marginal being reused. Average is exactly what it sounds like. It is the mathematical average, the mean. The marginal is obviously the change in input. So we're looking at a few additional units. What is the output? Okay, so in this specific example for marginal product, we're looking at what is the total production divided by the change in total production divided by the change in labor. So if a sixth worker increases output from 100 to 115, then the marginal product is 15 units. Okay, so that's sixth worker. So from fifth to the sixth, they have increased by 15 units. Therefore, that marginal product was 15 units. Please do not get confused between marginal profit and marginal product. Okay, that was a common occurrence in the exams as well. So the key relationships are also stipulated here. So when your marginal product is below your average product is falling. Okay, that means that your output per unit of labor is declining in this scenario. Okay, total product will always be how much your total production is. Okay, so we have the mathematical interpretation of these product measures. So we had total product, and I believe this is where we stopped last time. So here we have total product, okay, which is obviously all the output that you were able to generate. Average product is simply that total product number divided by the number of labor units you've employed or the number of workers you have. And then your marginal product is obviously how much has your output increased with each additional unit of labor. Okay. So these are where the relationships start to get a little bit more complicated. We will look at how these graphs are actually drawn in more simplified means, especially for the exam, but it is important that you understand the relationships between them and what each of these terms really means. Okay, so here we've got a practical example. We've got a factory with 5 workers and they produce 100 units of, let's say, tires daily. So the total product would then be 100 units, okay, because that's everything we produce. Our average product would simply be the 100 divided by the 5 workers we've employed. So it's 50 units per worker. That's a measure of productivity. So if we add a 6th worker, we now increase production to 115 units. Okay, what would our total product be there? 115 units. What would our average product be there? Well, we'd have to take 115 and divide it by 6. But for your marginal product, you're looking at the difference. Okay, so how much did this one worker increase your overall productivity? So we take the 100 units that we now produce with this additional unit of labor, and we subtract it from the original product we were able to achieve with 5 workers. And then we divide that over the difference between our current workforce versus our previous workforce. And our answer is obviously the 15 units that we've increased by. Now, how is this practically applicable? Well, because our marginal product is 15 units, which is less than our average product, it means that our average product will actually fall with the additional worker. So why it's useful is that if you are practically looking at whether or not to employ an additional person, you can employ them on a short-term basis and look at how that impacts your output, your product output. if you've reached a point where your average product is greater than that additional output produced by that additional person, then you know you shouldn't employ that person, because now you become less efficient than you were without that person. So without changes to your long run capital, labor is not going to fix your problem. Okay, so here again we have the 3 product curves and a visual representation. So you've got your total product, your total output produced from all of your input units. Okay, so we've covered that already. You can see here's your average product on the green line, and you've got your marginal product, which obviously goes quite high quite early and then declines quite sharply later on. Because as you reach a barrier with your employees versus your capital ratio, you'll see that this diminishing law of returns starts to come into effect. Okay, so in stage 1, you've got a scenario where your marginal product is rising. What does this mean? You don't have any overcrowding in your factory. So each additional person you add is a benefit to you. Okay, they're bringing in more product than they are costing you. Okay, so that's great. By the time you hit stage 2, now your marginal products is falling, so it's not increasing at the same rate, but it's still positive. So it's still adding a positive number. You can see here between 3 and 4. Okay, so at this stage, we were going from nothing to 1 person delivering 5 units. Then the next person delivering 10 units. Now we have a point where the next person is only delivering an additional 5 units. Okay, the marginal project is like 15. So we're increasing, but now it's starting to diminish the increasing level. Okay, so at this point, your marginal product is falling, but it's still positive. By the time you get to stage 3, now you start receiving negative returns. Okay, all the way down here. Okay, this is where you are now negatively impacting, which means that nobody is producing anything because you have overcrowded your factory. No one can move. Okay, so obviously where you'd ideally like to stop is right up here where you've maximized your marginal product. Or at this point here, where your marginal product is 0. Okay, you can't add an additional person without being detrimental to your factory. Okay, we have different stages of production. So you've got your increasing returns. This is where your average product is still rising as well. Each additional unit of labor, each additional person you employ is creating more products. Then you get to the point where it's diminishing returns. So here, your marginal product is slowing down. So hiring in more people is still positively contributing to the production output, but not to the same extent that hiring the first few people did. But you can still reasonably keep going until a point where the additional person is actually now creating a negative feedback. We're actually losing production. Okay, and that happens here at stage 3, where additional work is actually start reducing outputs. Now, expanding your output in the short run. Okay, so your primary methods are just obviously to add more labor, add more raw materials, while keeping your capital, your factories, and your equipment constant. Okay, so your production increases, but they are obviously still subject to the law of diminishing returns. Why? Because your capital is fixed. So you can add more people and add more materials, but there's a point where it's just simply not going to, there are the physical constraints that are not going to, serve the benefit of increasing production despite, increasing more of the variable factors. So why these inputs have to be homogeneous is because it ensures that any changes in output are due to quantity and not quality. So this is an assumption we have to make. Often in a production environment, they actually have a lab that ensures this homogeneity, because you can't have variations in the quality of your inputs, because that could mean that, for example, if you have if we're still in the production of tires, if you have terrible, like, natural rubber coming through the production system, by the time that you're trying to, use it as a thread, or a tread, it could be quite inefficient. So you could end up having to scrap a lot of rubber that isn't up to quality, but that has nothing to do with the efficiency of your plant, your capital, or your labor, or the amount of raw materials available. It is simply the quality of the inputs that you're putting in. So for economics, we have to assume that all the inputs are quality efficient. Okay. This allows us to make proper measurements of marginal and average productivity, because we're not disregarding any product, for the sake of it, or for the sake of quality. It is a very measurable thing, because quality is also a very hard thing to determine, or it's something that needs to be outsourced. Now, the role of technology in production is, obviously, technology is the one thing that gets cheaper as it gets better. So technological advancements improve productivity and enable more efficient use of your inputs. So technology is the one thing that overcomes diminishing returns. So, for example, if you are working in a scenario where you can instead employ 4 people and 6 AIs to do the same job, you could improve your outputs without having to increase your variable inputs. So technology investments represents like fixed costs that can lead to increasing returns on a scale version. Okay, so here we have revenue, cost, and economic relationships. So we have already looked at what is revenue, but we're going to get into a little bit more detail now, where we're going to start separating out operating revenue and non-operating revenue. So it's very much like what you've learned in accounting already. We have our 2 scenarios here. Okay, so revenue components in a typical business involve a combination of a lot of things. So there will be investments, there will be interest, there'll be asset sales, licensing, all of these different revenue sort of components that can be broken down to present to a management team. So if we look at product revenue, you've got a company that sells 1,500 units of product at, say, 20 Rand per unit. Okay, so that's a very easy product revenue calculation. But now if you've got multiple products, you've got product A, 500 units get sold at 10 Rand, and you've got product B with 300 units being sold at 25 Rand. Now you've got to add the revenue you've received from those 2 products together to get your total revenue. So we have operating revenue, which is to do with your core business functions. It's your primary source of business income. And then you've got your non-operating revenue, or if you're looking at in a business scenario, they call those non-core activities. So they are not core to the business function. They are simply, for example, they are investments that gain you interest. They are dividend income. It's if you sell foreign assets, or if you sell assets that are non-performing or poorly performing, then you can generate revenue from there. But it's not from your core operating business, so it's calculated in a separate part of your accounting process. There's also different types of profit. Okay, we have total profit, which is just very clean. We look at just total revenue and total costs. We have normal profits. This is what we consider to be the goal. We want normal profits, which means we want a minimum profit level to keep the business operating and sustainable in the long term. Then it is also considered part of your opportunity cost. So when we look at opportunity costs, we're specifically looking at things like economic profits, where we look at what is the nearest foregone opportunity, what were the profits that could have been made there versus the decision you actually did make. Whereas with accounting profit, we're just looking at explicit costs. So what were the direct costs like wages, rent, materials, those sorts of things. Whereas with economic profit, you could be looking at um, everything in accounting profits, but also what did you forego? So you're running your own business, but did you forego a 30,000 Rand a month salary? In which case, it reduces your economic profit because you've got to consider what the opportunity that you have foregone as well. So if you've made 100,000 and you potentially could have made a 30,000 salary, your economic profit is actually 70,000, not the 100,000 accounting profit. Now, when we look at these profit calculations, there is total profit, like we said, okay, because now we're looking at exactly the same concepts, just the mathematical basis for them. And here you see the different scenarios and how we examine these things. And you can also see why it's important for a business owner to understand these things, because it's not simply about, is my business profitable? It's about, if my main goal as an owner and as a person is to maximize my profits and generate revenue, then I have to consider the fact that in running my own business, I am also sacrificing the security of a salary. So whether, to look at your business in a sustainable way, you're going to have to consider what you're foregoing. You can't just pretend that that option doesn't exist. You make a more robust business system if you are cognitive of those things. Because in a scenario where your accounting profits start to drop to a point where your economic profits start becoming negative, then perhaps it's time to consider, closing down the business or, re-engineering something, but something is not working. Perhaps you just need to like supplement in some way to drop your implicit costs, or something needs to be done. But if you don't have this measure, you could continue down a dark path, without knowing that you're on the dark path. So there are different situations. So let's look at that. So you can either be economically profitable. So this is when your total sales exceeds your total economic costs. Okay, of course that does result in a firm earning above normal returns, which means they're going to attract new entrants into their market. Normal profit, this is where your total sales revenue equals your total economic costs. Okay, so you are considerate of the opportunity costs, but you're not making more than you need to. You're quite happy. An economic loss is where your total economic costs, so your explicit and your implicit costs, your opportunity costs, exceed your total revenue. Okay, so here again, we look at your firm may exit the industry in the long run. So if you can't stay economically viable for yourself, there's a good chance that the business will end up closing down if the owner doesn't take corrective paths. So it's very important to understand when you have reached this point where your implicit costs have started to make your accounting profits substantially less and even negative. Okay, so the key implications here are just long run versus short run. In the short run, a firm can continue despite these losses. So if you know that this is a problem, you can take corrective action. But in the long run, only firms earning at least a normal profit will actually, survive. So the market dynamics of profit and losses drive your resource allocation. So you have to understand what your profitability is in order to, drive your decision-making process. Here are the types of costs in the short run. You've got your fixed costs. They do not change with output level. And then you've got your variable costs, which do change with your production level. So when your output is 0, your cost is 0. But regardless of your production being 0, your rent will still remain. Your salaries will still remain. So those are the things that don't change. And that's why we call those your fixed costs. Because this can be quite an extensive, section in your work, we do a full breakdown of the difference between fixed and variable costs. I'm just going to highlight a few things. Fixed costs tend to remain constant, whereas variable costs increase with production. Per unit, fixed costs tend to decrease per unit. In other words, if you produce more units, you're spreading the costs over more units. Therefore, your fixed costs per unit are decreasing. But it doesn't happen with variable costs necessarily. So if you produce 10 units, you'll use 100 units of material. If you produce 20 units, you'll produce 200 units, or you'll require 200 units of material. So they tend to be relative to one another. There are scale effects that you need to be aware of as well. So with regards to that per unit decrease, we call that economies of scale. So as your output increases, you are spreading the costs across more volume, increased volume, and therefore you are decreasing the cost of that specific unit. Then we, of course, have mentioned break-even analysis. This is where your fixed costs start crossing over your costs start crossing over your revenue. This is determined by your fixed cost predominantly. Okay, so yes, of course. The last thing we need to cover is that marginal cost. So it's only affected by variable costs and not fixed costs. So your marginal costs do not decrease if your fixed costs are adjusted. It's only impacted by your variable costs. Why? Because we're only concerned with the increase in cost for the additional units you produce. Your fixed costs don't increase with the additional units you produce. You can see here, if we're looking at them graphically, your fixed cost is a straight horizontal line, whereas your variable cost increases relatively, so it is a straight diagonal. Your total cost is obviously a combination of the two of them, so you simply take that parallel and add it. So you'll see here 10 units, all we've done is we've taken the fixed cost, which was 500 Rand. We've taken the variable costs of 200, and our total cost is 700. You can see here, same thing. We're simply adding the two and getting our total costs. Okay, so the most important relationship is when the firm changes its variable inputs, its variable costs change proportionally. Okay, so obviously we do know that you can get deals and stuff like that, but we do assume homogeny in the inputs. Okay, so there is no variations. Now you've got your total fixed cost schedule. Okay, so this is where we're going to go back to incorporating average. Okay, so now we're looking at, we have our total fixed costs, and you remember that average fixed cost is simply means that we're going to take the fixed costs and divide it by our output level, and that's how we're going to get our average fixed costs. So this is a perfect representation of economies of scale. So your total fixed costs, your rental, for example, your insurance premiums, your equipment, taxes, those are your fixed costs. Okay, so that's say 5,000 Rand a month. Now that does not change irrespective of your output level. Whether it's 0 or 50, you're paying that 5,000. But your average costs are very different. So your average fixed costs of if you're producing 0 units and your total fixed cost is 5,000 is actually 5,000. If you're producing 10 units, you're going to divide your 5,000 in fixed costs by the 10 units you've produced, and it's 500. Do you see there's a massive drop? If you increase to 20 units, you again halve your average fixed costs. If you increase by another 10 units, you again come down by nearly 100 Rand. And you continually decrease your average fixed costs as your production goes up. The key characteristics of fixed costs: they must be paid even if production is zero. They remain constant throughout the short run expanse of your output levels, and the average fixed cost decreases as your output increases, which means you're spreading the overheads over all of your product. You're achieving economies of scale. Now we're going to look at your total variable cost schedule. Okay, so now your variable cost schedule will most likely always be represented on a table. The reason is because obviously while your total costs or your fixed costs are very predictable, your marginal costs vary quite substantially. Okay, so if we look at this output schedule, we've got the number of outputs here in units, and here we've got your total variable costs. Now, you remember your variable costs include your raw materials, labor, utilities, sales, packaging, all of those fun things. Okay, so obviously all of those things are impacted by the number of units you produce. Okay, so you need like 100 units, or you need 50 units of raw materials, you need 20 units of labor, you need 30 units of packaging material in order to make this one unit. Okay, so by going from producing nothing to one additional unit, it has now cost you 100 Rand to produce that one additional unit. If you now decide, okay, we've reached the point where we're going to produce 2 of these things, we are now going to hire an extra person, and so that's another 20 units of labor. We're going to need 30 units of packaging, and in fact, we're not going to employ another person. Therefore, it's only going to cost us 180 in total variable units, because we are just assuming that person is still going to be able to produce 2 units instead of 1 unit, because now we have improvements in understanding and learning, so we become more productive as people the more of the same product we produce. Okay, so we're assuming that has happened. So therefore, we have now increased our output by 1 unit, but our marginal cost has only increased by 80 units. Why has that happened? Because we didn't have to employ a second person to produce the second unit. Now we want to increase to 3 units. Okay, so at this point, okay, we know that our labor costs 20, our packaging costs 30, and our materials cost 50. So now we need to produce a 3rd unit. Okay, so in order to do that, we say, okay, we're actually going to take advantage of this packaging opportunity. We don't have to employ an additional person. So now it's getting even cheaper for us to produce another unit, because now to produce another unit, all we have to do is get the 50 Rand in raw materials. And then we just get 10 Rand in additional packaging material. Okay, so now it's becoming even cheaper for us to produce. But you'll see that there's a point at between 3 and 4. Here we've reached, no increase. Here we've flatlined. Okay, so at this point, we have reached our optimal level of production. Why? Because by the time we start trying to produce a 5th unit, now that one person can no longer just afford to just keep working and working and working. So we have to employ a second person. A second person means we are now spending 40 Rand on additional labor. 50 Rand for the product costs. We've got to employ the additional person for an additional 20 Rand, and we still have the packaging we have to pay for. So now the costs start to increase, because to hit this production of 5 units, we had to employ a whole other person. Okay, so At this point, it starts becoming less efficient. Okay, we can still keep going. Okay, so when we look at the key characteristics, obviously it starts at 0. Okay, please note that. Okay, your total variable costs will always start at 0, because whereas despite the fact that your total costing or your fixed costs will start at a point, your variable cost will always start at 0, because if you produce nothing, it costs you nothing. Okay, so initially it increases at a decreasing rate. Why? Because you're trying to hit economies of scale. So the more you start to produce something, the easier it becomes and the faster you get. Okay, so then you get, so quite here, you're just learning quite quickly. So one additional unit, it gives you a total variable cost of 100. By the time you're producing 2, you're at 180 because you got there faster, more efficiently. You're still improving. Here you got there even faster. Now it's, 3 units only took you 240 to produce. Okay, at this point, okay, here we're still optimizing because we've still increased our costing by only 60 Rand, but we managed to get 4 units, which means we've got more revenue coming in. But at this point here, now we're getting slightly tired. Okay, so now we're slowing down again. Now it's costing us 75 Rand to produce that extra unit from 4 to 5. We are now losing efficiency. If we push ourselves to get to the 6th unit, now we're like actually costing ourselves more than the initial start costs us. Okay, so if you are applying this to a more practical example for you as a student, this happens to you when you study. You start off with a bang. Yes, first hour down. Everything's great. It didn't cost you anything mentally. Second hour, you can feel it, but now it's starting to flow. You didn't have to take 20 minutes to get into the headspace of economics. It's just working. Yes, it's still flowing, but at 3 hours, you're starting to hit your barriers now. Okay, your brain's getting a bit tired. You need a bit of a break. But you're still so determined that you push to 5 hours, but now it's costing you. You can feel you're not absorbing at the same rate. You've reread the same sentence 5 times. Okay, but by the time you've pushed to 6 hours, I'm sure those of you who work have experienced this as well. This is the time we start watching the clock. Your brain's quite tired. You're not nearly as efficient. Every hour is costing you more and more. By the time you get to the 7th hour, well, my goodness, it's like you're starting at the beginning of the day again. You're still you're trying to keep your mind in the right place. You're just not as efficient. You're just, you could feel you're slowing down. It's costing you so much more. By the time you get to your 8th unit, my goodness, it's taking double what it took you when you started to just get back into the production vibe. So the shape reflects this law of diminishing returns. Okay, so how does this actually affect my business? Well, you've got your explicit costs and your implicit costs. This is why it becomes so important to know where you are profitability-wise and where you are in your cost schedule. Okay, what are the costs that you can also reduce and what are your fixed costs? So your economics costs include both implicit and explicit costs. So when we look here at this little table, your implicit costs are not visible on your financial statements. Okay, no one's going to, know how much you could, maybe you don't even know, but you can estimate what you could potentially earn in industry versus the explicit costs which are on your financial statements of your own business. It's on your income statement. It's on your trial balance. You know how much your business is bringing in. And on your balance sheet, you know how much your business has in assets. You've got a snapshot of your business. It's all there. Implicit is a lot harder. You are predicting, you are assessing. Okay, you want to be as accurate as possible. You want to try and not overestimate. You want a true reflection. If you obviously don't get this right, when you calculate your economic costs, you could drastically, reduce your economic profits if you overestimate your implicit costs. So it's important to have an accurate estimation. Your accounting profits, this isn't a consideration because everything is in black and white. It's explicitly listed. Revenue and costing, simple accounting profits. Opportunity cost is again a core concept. Why it is so important to understand the value of the next best alternative foregone. So it's also not even about whether to keep your business open because economically for yourself it's more viable to have a salary. It's about all the central activities, all the economic decision making of the firm. It's so essential for evaluating resource allocation options. So, for example, you could have two opportunities. You can have the decision that you made. So, you decided to spend 100,000 Rand on investing in new machinery versus the opportunity cost of investing in a marketing opportunity. Excuse me. So that was the next best alternative, but you've already made your decision. Now you need to understand what the ramifications of that decision are by looking at what the profitability of this new investment is versus what it could have been. Okay, so when we look at this total average and marginal costs, okay, sorry, I just need to see where we were on our schedule. Don't want to waste too much time. Okay, so when we're looking at total average and marginal costs, we've got just a summary of everything that we've looked at before, but now we're going to need to look at how these three things interact with one another. Okay, so here you've got your total costs of 500, okay? If the firm has a fixed cost of 200, they produce 10 units and their variable cost is 300, okay? That means they're spending about 30 Rand per unit. Okay, now all we have to do is look at the total cost. We just add total fixed costs and total variable costs, and we get 500 units. To establish their average cost, we take the total cost and we divide it by the number of units they've produced. And for the marginal cost, we are only concerned with what that last unit cost us. Okay. Here are your key relationships. You've got your marginal cost curve, where it intersects with your average cost curve. Okay. Over here, that is the minimum point. Okay. That is your minimum point of costing. So when your marginal cost curve is less than your average cost curve, your average costs are decreasing. This is what we want to see. But when your marginal cost curve starts to exceed your average cost curve, now your average cost is starting to increase. This is when you've hired too many people and your quantity is not being justified by your total, by the total output. Okay, now we have three measures of average cost. We've got average fixed cost, we've got average variable cost, and average total cost. Do you see why these total fixed variable, how these acronyms and letters become very important for you to interpret what the question is actually asking you? So the significance in this economic analysis is to determine optimal output quantity, make shutdown decisions, and price determination. So if your price is lower than your average variable cost, it's probably a good idea to just shut down production in the short term. Okay, so how does this happen? Okay, so we have sort of covered this. So your average fixed cost is exactly what it sounds like. Your total fixed cost divided by your quantity, variable cost the same. Your average total cost will be your total cost divided by the quantity, or your average fixed cost plus your average variable cost. You see, the reason we've laid it out like this is so you can see that it's mathematically sound. Your average fixed cost continuously decreases as your output increases. So obviously it's quite hyperbolic. You want your output to increases because it reduces your average fixed cost because you are spreading, you're reaching economies of scale. Average variable cost has a U shape because it's subject to diminishing returns. Okay, so your average variable costs tend to decrease as your total quantity increases. Obviously, your denominator is increasing while your numerator is increasing at a diminishing rate. Okay, average total cost is also a U shape, obviously, because despite the fact that they sort of counterbalance one another, you can see the U shapes depicted here. And your marginal cost intersects both of your average variable and your average total cost at their minimum point. So at this point where they intersect, that is where you have reached your minimum costing level. So let's look at this in a little bit more detail. You've got marginal costs and you've got marginal variable costs. Again, in the short run, you've got marginal costs, and it is always equal to your marginal variable costs. Okay, so mathematically, your marginal costs are obviously the change in total cost over the change in quantity, which you can follow through the whole thing. So it's either your change in total variable cost plus your total variable costs over the change in quantity, which also equals your total variable costs divided by your change in total variable cost over your change in quantity, and therefore you get your marginal variable cost. So essentially what we're trying to say is in the short run, marginal costing equals marginal variable costs. Now your unit cost schedule. So these are examples that you will see very similar to in your textbook. Pricing decisions, the three main areas, the reason we look at these costing schedules is because it's about pricing decisions. You can't determine what your price should be if you don't know what it's costing you to produce the product. And you'd be amazed how often entrepreneurs overlook costing. Production levels. You need to identify at what level are you actually producing to an optimal level and at which point are you producing to a point where you are creating a loss. What is your break-even point? At what point are you starting to become profitable? And how should you best allocate your resources? Okay, so here's a simple example of how these decisions are being impacted. Here are your different outputs. You can see your total costs will increase. Why? Because your marginal costs will continue to increase. Oh, your variable costs will increase. Okay, so here you've got your average cost, which is simply your total cost divided by your output. And here you've got your marginal cost, which is concerned with how much did these additional units cost you. Okay, so here we can see that increasing from 10 units to 20 units has cost an 80% increase in total costs. Divide that by the total change in quantity, and you've got 80 over 10, and that gives you 8. This is a point of optimal production. Okay, here you had a high unit costs. You can see because it could further be reduced here. Your average cost was far in excess of your marginal cost, so you can continue to produce. Here again, your average cost is still in excess of your marginal cost. You're reaching like optimal levels of production. But at this point, by the time you start producing 30 units, your total costs is increasing. If you only looked at those two things, you wouldn't have any idea of what's happening in your business. But simply by doing the maths of figuring out what the average mean is, your average cost is 15, which for the first time is lower than the marginal costs. So now producing those extra 10 units has actually cost you 70 extra units or in cost. 170 extra. Therefore, it's actually cost you 170 divided by the 10 extra units, and that gives you 17. So if you look at this point, this is a dangerous situation where you actually need to do something to prevent your business from becoming horribly unprofitable. Here we've got the representation, all of these cost curves laid out. You've got your marginal cost curve in green, your average total costs. You can see that the U shape in your total cost per unit. You can see as we produce more, so your average costs come down. Your average variable cost per unit, same U shape that we see. Obviously increasing eventually as you start to become less efficient by just increasing quantity. And then we've got your average fixed cost in purple, and that's always continuously decreasing because the more units you produce, the more your fixed costs get spread across. The economic insights that are quite interesting here, and you can look at the key relationships as well. The optimal production level for maximizing average cost is where your marginal cost equals your average total costs. It's the most efficient scale of your production, and that's the point where the firm has achieved economies of scale. Okay, so here are your key relationships. We have already covered these shapes as well. There is the law of diminishing returns. Again, we have looked at this both for cost and production. As production increases with fixed input, marginal returns eventually start to decline, causing per unit costs to rise. Okay, the cost impacts is each additional unit of output requires more variable inputs, driving up your marginal costs. We have different production phases. So initially, returns may increase because you're achieving economies of scale as your people get better at producing something, but it's often followed by this diminishing returns. Even you over a period of time become less efficient and less effective, despite the fact that you got more efficient in the beginning. Then there's the economic significance. In the long run, it explains why your average cost curves are typically U-shaped, and why firms have these optimal sizes, okay? Because we have these flattening of these curves, and that's essentially in the long run, because everything becomes variable, you can see why you have these U-shapes. There's a direct relationship in the short run between production and costs, obviously. And as the firm is trying to maximize their output, they're trying to minimize costs. But you'll often have these rising costs as your output increases beyond your optimal point. So that's when you start seeing the law of diminishing returns causing these marginal costs to rise, because you may have employed an additional person. But again, if you haven't provided for the capital, it could make your people less efficient over time. Then you've got efficiency reflections. So these cost curves tend to mirror production efficiency. When marginal product peaks, marginal cost reaches its minimum. Okay, so we want to maximize the difference between those two. So your optimal production level occurs when your average costs are minimized. Okay, so we've got production theory here on the left, your total product and how it rises and then levels out. Okay, your marginal product, it peaks and then starts to fall. And then by stage 2, by the time you start hitting diminishing returns, you start hitting optimal levels of production. On your cost structure, with your total costs, they rise as your output rises. Your marginal cost tends to fall initially and then rise. Think you are originally quite efficient in the beginning, but as your output tends to be extended, your costs tend to rise. Your minimum average total cost defines your efficient scale. Okay, so when marginal product falls, marginal cost rises. Okay, so that concludes our this section of the module. We will be looking at the different market structures and more about a little bit in the next session next week, Wednesday. If you guys have any questions, please feel free to email me at any stage. And this crucial framework is very important by understanding how businesses make their decisions about production, pricing, and resource allocation, the different forms of businesses that you can choose, and understanding what's happening in your business when you're being impacted by laws of diminishing returns and it starts impacting your fixed, variable, and marginal costs. You need to be able to understand how to still maximize your profit and optimize your resource allocation to keep your business sustainable in the long run. So the revenue and cost relationships determine your economic profits and they guide the decision making of your aspects of your firm, which often involve entry, exit, and expansion. Okay, this matches obviously because it provides the basis for real world business behavior and market dynamics. So understanding this puts you in a really good and powerful position. All right, guys, that concludes my lecture for the evening. Again, I wish you all the best. And I know the next assessment you have is the exam. So if you have any questions or any requests for resources, please let me know. I'm here to help you in any way you need. And all the best. I hope you have a wonderful week ahead of you. Have a good night, everyone. Bye.